Hello, I'm Deborah Trow, and this is the Elevation Market Update, where we bring you clarity on what's happening in the financial markets. Today, I am pleased to be joined by Dan Fierno from MFS Investments. Dan has 25 years experience working with mutual funds investing. Dan lives in Denver, Colorado with his family, and we are glad to have him back as a presenter again today. Welcome, Dan.
Thanks, Deborah. Great to be here.
And we are glad to have you. It's our first meeting of the year, which means we get to talk about what happened last year, what's coming up. So first of all, could you give us a quick overview of the highlights of what happened in the markets in 2022?
I guess they were more like lowlights, right, Deborah? Unfortunately, a year to forget, coming off the record highs of 2021. And if you just think about the backdrop that we had throughout the year, we had Russia invasion of Ukraine, the COVID pandemic is still here. We have high inflation, basically a lot of demand chasing too few goods on the supply side. And so the high inflation created a aggressive Fed posturing of raising rates. And so we had all of these headwinds come together in one incredible calendar year. And so, a negative year, both on the stock side, on the equity side, but also a negative year on the bond side. We haven't seen that since 1969. I want to say, if I remember my history, and before that was 1931. So very unusual that we have two sides of the ledger, bonds and stocks, returning negative for a calendar year. But again, with those headwinds, you can see the volatility that was present and persistent in the market in 2022. But opportunities from here certainly present themselves. So let's look forward to 2023, shall we?
Yes, let's start over again. And so just to remind everybody, the overall drop in the equities market was just shy of 20%, right?
Yep, just under 20 for the S&P, correct.
Yes, exactly. So one of the biggest concerns is that people lost money in their bond positions. We generally think of those as being a safer kind of area to invest. So what happened there?
Yeah, I think to the point, Deborah, of just this aggressive Fed hiking cycle. If you look at the history, going back the last 5 Fed hiking cycles, we've had 290 basis points or 2.9% of hikes, and that was over 20-month periods. So kind of a slow, steady over a long period of time was the cadence of those hikes. And then flash forward to 2022, pretty historic. We had 425 basis points or 4.2% of movement within 10 months. So, the trajectory of that increase was extreme. And obviously at the end of the day, trying to kill this inflationary factor in the marketplace. And so when rates go up, what happens to the bond prices? They go down. And so that was the pain you felt in 2022. But for the first time in many years, we finally have fixed income. There's now income on the fixed income side of the ledger. And so there's opportunities going forward because now you have a pretty big cushion with higher yields to buffer any type of maybe further movement by the Fed. And certainly if you look at yields, whether you're looking on the investment grade side or munis, incredible outflow cycle in the muni market, tax-free market last year. Again, historic, we saw $122 billion go out of the municipal market, which is historic. And we had $121 billion come in 2021. And if you think about 2021, you look at where the investment grade muni index was from a yield standpoint, it was a little over 1%, 1.2, 1.3%. It's now over 3%. So all this money coming in with that low yield in 2021, now you have a lot of redemptions in 2022 at this higher level, over 3%. And now we're starting to see some opportunities certainly there, and money is starting to flow back into market like munis that present a pretty interesting opportunity for people looking for tax-free income.
Yeah, and it's so interesting that people respond very quickly, don't they? They see their bond prices going down, and then you talk about money flowing in and out of the market, but that's investors deciding that they don't want to be in their bonds anymore, and that also starts to drive the market. And of course, for 2023, we've spent a whole year, I've spent a whole year urging our investors to stay the course and not be one of those investors that just fled away from their bonds, hopefully. So
Right.
The big question is the Federal Reserve going to keep raising interest rates?
All right, so my crystal ball broke yesterday, Deborah. I apologize. But I think if you look at market consensus, I think we're certainly closer to the end than we are any type of beginning of higher for longer. So I think you could see it a situation where you have 25 basis points for the next couple meetings, and they go into a pause. We've seen that inflationary number come off a double-digit number down to 6.5 was the last reading. So I think we're closer to the end of that cycle for sure. And certainly there's some pundits out there that are saying that we might see the Fed start to lower rates if we do get into some type of recession here in 2023. And that's the famous Fed pivot is what they call it, where the Fed changes direction and starts to become accommodating from a monetary standpoint. So I think it's closer to the end, maybe a couple more, potentially. No one knows. But the fact of the matter is we've come a long way. I think there is some type of pause in there. I think the inflation number continues year over year. Numbers continue to soften. And I think, again, that presents opportunity for long-term investors in this market environment.
And there is always opportunity. That's an important thing for investors to remember, isn't it?
No doubt. No doubt.
Yeah. Yeah. One of the things I've been asked about, you mentioned the possibility of recession. I think people are warming to the idea that, yes, we may be having a recession, but is it going to be mild or is it going to be a big one?
Again, crystal ball broken yesterday, but I think if you look out, the consumer certainly is in a better position. If we do have recession this year, the consumer is so challenged in the global financial crisis going back to 08, 09, with just some of the loans that were out there in the mortgage markets, the liar loans, everybody got levered up, and certainly we went into a pretty challenging recessionary environment. And I just think consumer this time around is pretty healthy overall. And I think you're seeing, softening certainly from an economic standpoint, where you look at the housing numbers, which typically are a lagging indicator. But the fact that we still have a pretty robust labor market, unemployment's pretty low. If you want a job, there's job openings out there, and really, I think that should provide a cushion for consumer spending and household income, which should, again, that cushion should provide a milder recession if that is the case for 2023.
If that's the case, yes, we won't know for quite a while whether recession is really happening. And just means that the economy is staying slower for longer, doesn't it?
Exactly. It doesn't mean that there's really anything to be tragically worried about. I think, again, if there's any type of recession, it presents opportunities for long-term investors. If maybe we get a earnings recession out of corporate America, then valuation certainly might be more attractive as far as an entry point. And certainly if we go through a mild recession, then again, that presents opportunities when we get through the recession and the Fed starts to cut rates and helps out corporate America for sure. and the consumer.
Okay. Yeah, so Dan, as we said, you've been doing this for 25 years, so you have been through many business cycles, downturns and recessions, and you've worked with MFS through all of this and their mutual funds. So what is the strategy looking like as far as MFS goes with all the funds that you handle?
Yeah, great question. Yeah, I mean, the fact that we have over 60 solutions, so well diversified across the bandwidth of aggressive to conservative, large companies, small company, international, domestic, etc. But I think really the mantra, certainly for MFS, I mean, our claim to fame is we invented the mutual fund back in 1924. So, think about 99 years of history. It's always been about long-term discipline and really investing over full market cycles, looking at quality companies that are durable, that can hold up better through maybe recessionary environments, and can compound over long periods of time. So if you look at the playbook, last year it was about value style companies that typically are a little more defensive. Certainly, the only sector of the S&P that was positive last year, shocking, was energy, right? And it was close to 60% upside in just that sector. Everything else was negative. But I think if we're looking at recession somewhere in 2023, then having a nice balance of value that might hold up better, potentially in the first half with more defensive sectors like consumer staples, with healthcare. And then if we get out of recession and the Fed maybe pivots, then I think there's opportunities certainly on longer duration assets like growth that's certainly been trading at some in some areas at interesting discounts. So I think again the key is long-term discipline. I think the playbook has been a tilt towards value, which, let's remember, 2 years ago it was the most hated asset class out there outside of international, and there's a lot of people that just said, all right, it's growth, 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 tech, 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 and certainly didn't work out so well when the Fed started raising rates and those future growth 3 to 5 years down the road gets discounted through that rising interest rate environment. So I think the playbook is still to have a little tilt towards maybe some defensive areas of the market, but again, this isn't all or nothing. It's about having a portfolio that's well diversified and certainly having a quality bias at this point.
Yeah, so it's a case of not just ditching any one type of investment because it's not doing well right now. And I know that when we talk about, oh, what's happening today, what's happening in 3 months, 6 months, a year from now, mutual fund companies like MFS, they're looking several years out, I imagine, as well as in this time period.
Exactly. I mean, you look at MFS value portfolio that typically has a holding period, low turnover. You're looking 7, 8 years out. So we're not really worried about certainly today what the next quarter's earnings look like. I think it would have been easy for a manager to pivot maybe to some of the performing areas of the market in 2022, which would have led us to lower quality cyclical names. Certainly energy it's been underweight for us just because it doesn't hit that quality durable franchise, durable company theme, if you will. Certainly it's capital intensive, it's labor intensive, and you're beholden to a commodity mechanism you have no control over. The fact of the matter, you had a war in Ukraine and energy went through the roof. So we did not change our stripes to appease the market after first quarter. And if you look after consecutive quarters, the market did start to position towards quality. And that, again, was where we were positioned. So having that long-term discipline and that longer holding period allows us certainly the opportunity to compound returns over long periods of time.
And continue to delivering quality for our investor clients. So as we're moving along here, let's talk about, what is an investor to do? What are your comments towards them?
Yeah, I mean, I think it's really easy, and I think you made the point, Deborah, to look at today's news and maybe make rash decisions off short-term performance or what worked in the rearview mirror. But it's about having a game plan. It's about not just having value, but growth. Worked great in growth 2 years ago, not so well going forward. But that's the plan that you put together, and that's the confidence the client should have. It's not fearing tomorrow, but looking for the opportunities with this diversified portfolio that you built especially for their risk tolerance, their time horizon, et cetera. So believe in the plan, and I think that's the best advice I can give any investor in the marketplace.
Well, thanks, Dan. This is all great information to get us started with the year. And remember not to panic about what's going on, to keep steady. If anyone has questions, we'll be delighted to answer about any of the market issues or your own situation as you consider how you and your family get through these times as well. Our next market update will be in about 8 weeks' time. We'll be sending out the recording of today. So thank you very much, Dan. It was great to talk with you this morning.
Thanks for having me, Deborah. Take care.
Thank you.